The new tax bill just increased how much you can deduct on your taxes by up to 400%. Now, this is because they increased the SALT cap from $10,000 to $40,000 starting this year. And if you combine it with a bunching strategy, you may be able to save thousands of dollars in taxes. And that's what I'll show you in this video to see if you can actually take advantage of this. Now, to step back, every year you can choose to either take the standard deduction or itemize your deductions on your taxes. Now, for itemized deductions, that includes state and local taxes, like state income or sales tax or real estate or personal property taxes. It includes mortgage interest and gifts to charity. Now, the majority of people, they take the standard deduction, but this law could change that since the limit on income tax and property taxes is now $40,000. Let me give you an example. Say you live in Illinois, which is a high state tax, and you've paid $5,000 in state income tax and then $9,000 in property tax for the year. Previously, before 2025, you were getting a cap of $10,000. You could only deduct $10,000. That's what was allowed. But now the full $14,000 is going to be deductible. You might be thinking, well, my state doesn't have state income taxes. Well, you can use your sales tax, either the actual sales tax paid for the year, or there's an IRS calculator to estimate what they would be for that year. But now let me tell you about the creative tax strategy called bunching. Here's how it works. So this is really, you alternate years between taking the standard deduction in one year and then loading up your itemized deductions in the following year, or vice versa. As an example, you'll want to check with your county to see if you can prepay your real estate tax or your property tax bill. So if you've got two normal payments that you make in this year, see if you can prepay the following year's real estate taxes in the current year. That's one way to kind of front load itemized deductions. Another one is if you're a giver, if you donate to charity, you may be able to, let's give you an example actually. If you usually give, let's just say $10,000 a year to charity, you could pre-fund the giving for the next 2 or 3 years. So let's say over the next 3 years, you're going to give 30,000. You could pre-fund the 30,000 this year by giving to a donor advised fund and get the full deduction this year. And then that donor advised fund will continue to grant out over the following 2 or 3 years to the charity. So nothing changes for the charity, but you get the full deduction this year. If you're interested in that and donor advised fund, check out this video on the full donor advised fund strategy here. So there's just a couple ideas I wanted to give to you so you can bring it to your CPA or bring it to your financial advisor on this bunching strategy, because it could be a great way to maximize deductions and think about taking an itemized deduction in one year and then standard deductions the following years. And if you live in a low tax state, maybe this won't make a huge difference, but for a lot of retirees, especially in high tax states, this could save a few $1,000s each and every year.